Hello everyone, I am Rahul sir, your management educator. Welcome to Global Online Platform. As you know, our crash course is running on most important topics of management. So we are discussing the unit number 5, financial management. So today we are going to cover one of the most important topics, that is derivative, in which we are going to cover the forward contract, future contract, option contract, and swaps. These every time NTA asks a question from this topic. So this time also there is a major probability of asking the questions from this topic. Let's start. Before starting, I would like to tell you, if you watch this video completely, you won't have any problem in this topic again. So there is an important information for you that the UGC NET Management Paper 2 exam is very close. If you take this our UGC NET Management Paper 2 course, you will get complete video lectures, full syllabus notes, test series, and PYQs PDF with explanation. This is going to be a target-based preparation. As you know that anytime the NTA may release the notification regarding the exam dates. So this is the right time to boost up your preparation. The main feature of this course is, if you course this paper 2 course, you will get the paper 1 totally free, which has the same advantages as available here in paper 2. So this is the content we have provided for your benefits, which will help a lot to achieve your JRF. So what you have to do, you have to download our global online app. After logging in, you will see the home interface. In this home interface, you have to press the second button, store button, and here we have you have two options, that either you can search in the search bar like UGC NET Paper 2 Management, or just click on the fourth paper, UGC NET Paper 2 Management. You will get the fees of this course is rupees 7,000 only, and the validity is 1 year. Okay. So if you have any queries regarding the course, you can contact on the given number through WhatsApp, or if you want to join the batch, you can contact on the given number. After joining the batch, you can get the n number of times access of this course, and you will be added to your WhatsApp in our WhatsApp group, where we resolve your doubts. Let's continue. Let's begin. So in today's lecture, we are going to cover the following things. What is derivative? What are the difference between spot market and derivative market? Then parties in the derivative market. Then difference between the over-the-counter and exchange markets. Then types of contracts in derivative, which is the most important parts. Here we are going to cover the forward contract, future contract, swap, and option contract. This is the most important topic from exam point of view. NTA most probably it is quite complex, but if you listen to me carefully and try to understand with focus, you will get to know about the topic, and you will be able to attempt the question in exam. Let's understand one by one. First, understand what is derivative. Actually, as the word suggests, in derivative refers to what? Here, a little spelling is there. Sorry for that. This T is not there. It's derivative. Okay. The term derivative stands for a contract whose price is derived or is dependent upon an underlying asset. Deriving a value from an underlying asset is called a derivative. Okay. The underlying asset should be a financial asset such as currency, stock, and market index, and interest bearing security, or a physical commodity. The derivatives are of different, the following things are covered under the derivative market, like physical commodities, market index, interest bearing securities, or the currency or stock. Okay. So this is the concept of derivative, because first of all, unless we start from basics, we will not be able to cover the few things which are stated forward. Then we have, what is the difference between the spot market and derivative market? Derivative market is little bit different from the spot market. Spot market is what? Suppose I have to buy ice cream. as the summer season is going on. That's why I'm giving this example. So what I will do, I will go to the ice cream parlor, offer him the money or pay it through the Paytm and take the ice cream and come back. On spot dealing will be done. But I cannot say him that भैया ये लो 10 रुपए ले लो, मैं आइसक्रीम कल लेके जाऊंगा. ऐसा होगा क्या? नहीं होगा ना ऐसा, क्योंकि आइसक्रीम तो उतने देर में आइसक्रीम का राम नाम सत्य हो जाएगा. उतने देर में पूरी आइसक्रीम की वाट लग जाएंगी. My money will be wasted. So in case of spot market, the transaction is takes place immediately. What is traded in the what is exchanged in the spot market, the financial assets are traded. In case of derivative market, financial instruments which are known as contracts are exchanged in the derivative market. Okay, there are examples also given in spot market like cryptocurrency, stocks, foreign exchange currencies. These are traded in the spot market. But in case of derivative market, futures, forwards, options and swaps, these are traded in the derivative market. Don't worry, these things are in detail in the upcoming slides. Then time horizon. Executed immediately. Spot market is in case of spot market, the transaction is executed immediately, and in case of derivative market, it is executed at a specific time at a specific future date or after a specific time interval. Then we have complexity. The complexity of spot market is straightforward. There is no, it's not complex. Just go pay the money and take the thing. But in case of derivative market, these are highly complex, as the lot of risks are involved in the derivative market. The n number of the formalities are there, so these are complex. Then again, the same point is mentioned, complexity. The flat crypto exchange regarded the pure crypto exchange isn't. Okay, then it is fully regulated. Derivative, remember this point can be asked in exam. The spot market is not well regulated, but derivative market is fully regulated. Okay, let's understand who are the parties involved in the derivative market. Derivative markets, we have generally three parties who are involved in the derivative market, like hedgers, speculators and arbitrators. The hedgers are the player whose objective is risk reduction. These people are afraid of risk, afraid of taking the risk, so they are risk averse in nature, and they trade in such a way that they should not face any contingent problem due to as they kept the risk lower. Okay, then we have speculator. Speculator are the players who establish position based on their expectations of future price movements. Okay, they are speculators are those persons which do not afraid to take risk. They like to take risk and they want to earn money, so they establish such a position based on their expectations on the future price of the movements. Okay, then arbitrators are these are the players whose objective is to earn the profits by selling in by pricing in differentials. Okay, let me tell you in another slide. Just see here. One we have the hedger, one we have the speculator, and one we have the arbitrator. Okay, these are the three people. Hedger are risk averse. Then speculators are, the risk is like girlfriend in case of speculator, risk lovers. Okay, and the arbitrage are the most rascal people, because what they will do, whatever the difference is between the prices, whatever this price difference between the prices, to earn profits, they will sell the commodity, buy in one market and sell at higher rate. I am writing in short. In other. Okay, I hope now it's clear. Hedgers are the people who don't like to take risk, but the speculators are risk lovers, so they take much risk. And arbitrage are the people who check the differences between the prices, and to earn higher, earn more profit, they buy in the one market at lower price and sell in another market at higher price. Okay, I hope this is clear. Let's see some concepts regarding the arbitrage, some points regarding the arbitrage and speculators. Arbitrage is the process of the simultaneously buying and selling to take the advantage of price and yield differentials. Okay, I told you earlier that these people work on the price differential and take the advantage from another market. Then speculators. Speculation is the process of taking an open position and hoping that, example, the exchange rates will move towards the expected direction. Okay, exchange rates will move towards the expected directions. Then spot market speculation, forward market speculation, and option market speculation. So these are the people who will deal in the spot market, at the in the forward market, and in the option market. But the arbitrage, but the hedgers, in case of hedgers, if you say hedger will hedger people who are the hedgers, who are risk averse, they will deal in the future market. Okay, देखो जो हेजर रहेगा वो फ्यूचर मार्केट में ट्रेड करेगा, जो स्पेकुलेटर रहेगा जिसको रिस्क से बहुत प्यार मोहब्बत है, वो कहाँ ट्रेडिंग करेगा, वो स्पॉट मार्केट में अपनी डीलिंग करेगा, फॉरवर्ड मार्केट में डीलिंग करेगा, एंड ऑप्शन मार्केट में डीलिंग करेगा, बिकॉज वो क्या चाहता है कि मैं ज्यादा से ज्यादा रिस्क लूं और ज्यादा से ज्यादा प्रॉफिट कमाऊं. बट दो आर्बिट्रेज रहेंगे, ये क्या रहेंगे, ये सबसे हलकट लोग रहेंगे. ये क्या करेंगे, ये जो अपनी बाइंग एक मार्केट में खरीदेंगे कम प्राइस पे और दूसरे मार्केट में जाके उसको बेच देंगे हायर प्राइस से, ताकि जो बीच का डिफरेंस है उससे वो प्रॉफिट ले सके. आई होप यू माइट हैव अंडरस्टूड. Now let's understand what is OTC, that is over the counter, and exchange. What is the difference? Then first let's understand the meaning. Over the counter, OTC is the decentralized dealer market, whereby the broker and the dealer transact directly in the computer networks and phone. Okay, this is the counter-based transaction, where the dealer decentralized one, where the dealer and the brokers and the dealer transact directly from the computer networks and phone. Okay, then in case of exchange is the organized and regulated market wherein the trading of the stocks takes place between the buyer and the seller in a safe, transparent and systematic manner. I hope like the Bombay Stock Exchange is there, National Stock Exchanges are there. These are what? These are well organized markets where the buying and selling of different currencies take place. Okay, then in case of market maker, who OTC is the dealer and the exchange is the exchange itself. Okay, then the OTC is used by small companies and exchange is used by well-established company. Okay, then in the physical location, on the spot, over the counter has no physical existence, but the exchange has the physical existence. Okay, then the trading hours for the over the counter transactions is 24/7, and for the exchange hours, this is exchange hours for. This is for exchange hours. Like in our India, the exchange market is available for, in my opinion, it's from 9 a.m. to 3 p.m. I don't know the exact timing. I don't trade in this market. So, but in my opinion, it's 9 a.m. to 3 p.m. Okay. Then stocks. Then unlimited stocks can be traded in over the counter market, but the limited stocks are allowed to trade in the exchange market. Then we have transparency. The transparency in OTC is low, but the transparency is comparatively high in the exchange market. Let's understand the contract. The nature of the contract in the OTC is customized. They are customized contracts, but in case of exchange market, these are standardized contracts. Proper standards are followed in this exchange traded market. I hope this is clear. Now let's see the types of contract in derivative. The most important one, that is forward contract, future contract, options contract, and swap. These are the four main types of contracts in the derivative. Okay, let's understand one by one. Forward contract. These are the promises to deliver the asset at the predetermined date in future at the predetermined price. Remember this point key in case of forward contract. Whenever we talk about the forward contract, an asset will be determined of which the price will be predetermined, and the date will also be predetermined. Okay, then forwards are highly popular on currencies of interest rate. Forwards are highly popular on currencies on interest rate. Okay, then these contracts are traded over the counter. OTC we have discussed just now. These contracts can be traded over the counter, that is outside the stock exchange markets, directly between two parties, and are customized according to the needs of the parties. Here what will happen, two parties will there, they will agree on the contract themselves, and their conditions will be decided among themselves. Okay, since these contracts do not fall under the preview of the rules and regulations of the exchange, they generally suffer from contemporary risk. Contemporary risk means there is a high chances of contingency, because they don't fall under the any they don't follow the any rules and regulations related to exchange market. Okay, then the risk, the default risk is high in the case of the forward contract. Okay, they may not be if one party do not fulfill the other's obligation. Let me understand. Let me give an example for you from where you will be able to understand properly. For example, let me change the pen color. So we are discussing the example. So let's discuss. Here is one person. Party A. Okay. And here is another person. My drawing is not like you, but try to understand. Now what happens? He says that they are dealing in case of crops. Okay. So they are dealing in crops. He said that after 3 months, I will give you 3 quintal wheats. They are dealing in wheat at the rupees 5,000 per quintal. इतना महंगा तो होता नहीं, but we are just discussing an coincidental example, so we are discussing. But what happens? They made an agreement and a contract, but after 3 months, if this person goes to him, just a second. So what happened if this person goes to him after 3 months? 3 months later, then and he rejects कि हमारे बीच में तो ऐसा कुछ हुआ ही नहीं था. He rejected कि हमारे बीच में तो ऐसा क्यों नहीं हुआ, कुछ हुआ ही नहीं, and he take the money in advance. This person had taken the money from him in advance. So क्या हुआ? रिस्क ही तो हो गया ना उसके लिए. इसने तो बोला कि इसने तो पैसे दे दिए कि मैं इतने पे लूंगा. बाद में अगर ये मुकर गया, if person A disagrees that I will not give you, मैं नहीं दूंगा तुमको, तो क्या हुआ? B का तो नुकसान हो गया ना. B faced the risk. So this is about the forward contract. High amount of risk is involved in the forward contract because the one party may change his opinion at the later period. Okay. So this was the example of forward contract. You might have understood. If any doubt you have, you can ask in the comment section. Okay. Now let's discuss what are future contract. A future contract is an agreement between the two parties who buy or sell an asset at the certain time in future at the certain price. Here the price will be certain and not be predetermined and after certain time. Okay, these are the basically exchange traded contracts and standardized contracts. Okay, these points are very important, that the forward contracts were customized, but these are standardized. Okay, then the exchange stands guarantee to all the transactions and contemporary. If any case happens, this will be said that the exchange stands who are the third party will take a guarantee that they will not make any party to lose. Okay, thus the risk is largely eliminated. There is less risk as compared to forward in the future market. Okay, remember this point. Then the buyers of the future contract are considered having a long position, whereas the seller are considered to be the having a short position. Remember this, the buyers will have a long position and the seller will have a short position in the future market, in the future contract. Okay, future contracts are available on the varieties of commodities, currencies, interest rates, stocks, and other tradable assets. These are highly popular on the stock indices, interest rates, and foreign exchange. Okay, so here what you have to remember that these are standardized contracts. These are exchange traded. The buyer has the long position and the seller has the short position. As for seller, as for short position. B for buyer, B for long. BL and S square. You can remember in this way. Okay. Then the future contracts available at the varieties which are mentioned here, that is interest rate, stock, then tradable sets, high popular stock indices, and interest rate and foreign exchanges. Okay, this was all about future. Now from this chart you will get clear everything. Okay, then for the meaning we have discussed, so I will not discuss it again. What is it? It is a tailor-made contract. Forward contract is a tailor-made contract. Then future contract is a standardized contract. Okay. Then it is traded on over the counter. That is, there is no secondary market. There is no secondary market involved in case of forward contract. But in case of future market, they are well organized and took the exchange. Okay, well organized stock exchange. फ्यूचर जब भी होगा, फ्यूचर वेल ऑर्गेनाइज तरीके से होगा, स्टॉक एक्सचेंज मार्केट में होगा. लाइक देन द सेटलमेंट इज डन ऑन द मैच्योरिटी डेट एंड the settlement is done on a daily basis in the future market. Okay, the risk is high in the forward market, as I gave you the example earlier, that there is default risk is high in case of forward market, but in case of future markets the default risk is low. Why? Because there is third party involved who takes the guarantee that he will not let you lose the money which you are paying. Okay, in case of in exchange of the money, you will get that particular benefit or stock or whatever you want to take. Okay, then default, as they are private agreements, the chances of default is relatively high. The chances of these are privately agreement, so default risk is high, but no such probability of any default risk. Okay, then the size of the contract depends upon the contract terms. The size of the contract depends upon the contract terms, but in case of futures these are fixed. Okay, then there is collateral. No collateral is required in case of forward contract, but in case of future contract, initial margin is required. Okay, then the maturity, as per the terms of contract, maturity is, can be as per the terms of contract, but in future it can be predetermined date, but future can be traded before that date too. Okay, then regulation is a self-regulatory, as there is no third party involved, but in case of proper stock markets, stock exchanges are involved, so they are well regulated. Okay, these are regulated by stock exchange. Then we have liquidity. The liquidity of forward market is low, but the liquidity of future contract is low. Okay, forward contract, the liquidity is low in case of forward contract, but in case of future contract, the liquidity is very high. So let's this is another chart. Let's understand, is there any separate point? Then this one, mode of delivery. In the last point, mode of delivery, the specifically divided into some result in delivery. In case of the mode of delivery is specifically divided some result in delivery. Okay, but in case of futures, this is standardized. Most contracts do not result in delivery. Most contracts do not result in delivery. Okay, then we have price of contract remains fixed till the maturity. No fluctuations will be there in case of forward contract, but there will be changes will be there in case of forward contract on daily basis. Okay, then size we have discussed, margin we have discussed, then counterparty risk is present, but here in case of future, counterparty risk is not present. Then there are, in case of forward markets, any number of contract can happen, but in case of future market, it is fixed by the exchange, that a certain number is fixed from the exchange markets, exchange trade. Okay, then hedging, tailor-made or specific duties and quantity, but these are done by the using the nearest month or the fixed lots. Okay, fixed lots are there in case of future markets. Rest all the point we have discussed in both the charts. I hope forward and future are crystal clear to you. Let's understand what are swaps. Swaps are the privately agreements between the two parties to exchange the cash flows in the future according to the pre-arranged formula. They can regarded as portfolios of forward contracts. Swaps are regarded as the portfolios of forward contracts. Here mainly the currencies are traded in the form of cash flows. Okay, there are two types of swap. One is interest rate swaps and second is the currency swap. In case of interest rate swaps, these entail swapping only the interest related to the cash flows between the parties in the same currency. The currency will be same. The principal will not be exchanged. The principal will not be swapped, but only the interest which is to be paid on that principal, that will be swapped. Okay, so it is interest rate swap. Next comes the currency swap. Currency swap, these entail the swapping both the principal and interest between the parties with the cash flows in one of the direction being a different currencies than those by the opposite direction. Here what will involve, currency will be involved, and both the principal and exchange will be traded. Okay, I hope it's clear, both the currency swap and interest rate swaps. Let's see the last one, that is option contract. Till now we have discussed the forward contract, future contract and swap. Last comes the option contract. Option gives the buyer or the holder a right to buy, but not to sell. Obligation. Right will be given to the buyer, but not the obligation will be given to buy or sell an asset in the future. A buyer gets a right, but no obligation is given. Okay. Then options are of two types, call option and put option. Call gives the buyer to right, but not the obligation to buy. CB. CB means in case of call, remember the buy option. Okay. A given quantity of the underlying asset. In case of call option, the buyer can buy the given quantity of the underlying asset at the given price and before the maturity date, before the future date, it can be buy. But in case of put gives the buyer to right, but not to obligation to sell. PS. This can be remembered easily by using the second, my pen is not working. In case of call, there will be buy, and in case of put, there will be sell. But in both the conditions, there will only be right, but there will be no obligation. This point is most important. Right will be there, but no obligation will be there. In case of call, you can buy the currency, but in case of put, you can sell the currency. Okay. Sorry, underlying asset, not currency. It gets the underlying asset on the price before the given date. Okay. Option has a expiry date. Always remember, no, in case of future and forwards, there was no concept of expiry date. But in case of options, there is a concept of expiration date. Okay. The buyer has the long position, in the seller has the short position. This point you should remember. The buyer has the long position in the, and the seller has the short position. Then let's see the next points. It should be noted that first two types of contracts, that is forward and the futures, both the parties, the buyer and the seller, have an obligation. In case buyer needs to pay for the assets, and the seller needs to the seller, and the seller needs to deliver the asset to the buyer on the settlement date. On the particular settlement date, the buyer has to pay the amount to the seller, and the seller has to deliver the assets. But in case of options, only the seller, also called as option writer, is under the obligation and not the buyer. Buyer won't be under the obligation, but seller will be, because being an option writer, he will have the right. Okay. Option purchaser. The buyer is called as option purchaser. Okay. The buyer has the right to buy that is call option, or sell the put option, the asset from us in the buy the asset from, or the seller has the option, but may or may not exercise this right. They can't exercise. Okay. Then increase the in case of the buyer of the options does exercise the right of the seller, option must fulfill whatever this is obligation. For the call option, the seller has to deliver the asset to the buyer of the options. But for a put option, the seller has to excise the assets from the buyer in case of the option. Okay. This last point may not be clear to you. Let's understand this from this chart. Okay, this chart will clear your doubts. In case of call option, it offers the right but not the obligation to buy the underlying assets at the particular date at the pre-decided strike price. Strike price is pre-decided. Then in case of put options, it offers the right but not the obligation for the selling the underlying assets at the particular date for a pre-decided strike price. Okay, the strike price will be pre-decided, but they have right to. In case of put, I told you earlier, selling will be done, and in case of call option, purchasing will be done. Investor expectation, there is rise in prices. Price will rise. The investor expects that in case of call option, there will be rise in the prices, but in case of put option, the investor expect that there will be fall in price. Okay, then profitability. The gains can be unlimited. Unlimited gains will be there since the price rises cannot be capped. Okay, there is no cap on the rising price, so it will result in huge profits. But in case of put options, gaining are limited since the price can fall. Gaining are limited since the price can fall readily, but will stop at the zero. Okay, then what are the next point? In case permits, in case of permit, only permits to buy the stock, and the put option only permits the selling of the stock. Last point is analogy, considered as a security deposit, allowing the making the products at the certain exchange, certain fixed price. It means that it is considered that the security deposit is allowed to take the product at the certain fixed price. Some security you have to keep to buy the product in future at certain fixed price. Then in case of put option, it is an insurance offering the protection against the loss in the value. If any loss occurs, you have to keep some money in advance to overcome that loss. Okay. Then let's see some option terminologies. you have, it's all about root learning on the, the given option terminologies are all subjected to root learning. You will have underlying is the specific security or assets. Okay, as we have studied. Then what is option premium? The price which is paid extra is option premium. Okay, what is strike price? Strike price, the price which is pre-decided is strike price. Then what is the expiration date? Date on which the option expires. The options should always be traded before the option expires. Then exercise date. Exercise date option is the exercise, the date on which options are exercised. And then the open interest. Open interest is the total number of the options contracts that have not yet been expired. Means the option contracts which are outstanding are covered in the open interest. Then option holder. One who buys the option is called as option holder, and option writer is one who sells the option is the option writer. I hope this chart might have cleared the terminologies which are related to option, by which you will be able to understand the different points which are mentioned in the option in this previous slide. Okay. Then let's understand the moneyness in the option. Moneyness, what are the moneyness in this option are given here. Then as we see, whenever the strike price is greater than whenever the stock price is greater than the strike price, in case of call option, it is in the money, but in case of put option, it is out the money. But when the strike price is equal to, when the stock price is equal to strike price, both are equal, it will be, in case of call option, it is at the money, and in case of put option, it will be at the money. Okay. But in case of stock price is less than the strike price, in case of call option, it will be out of the money, and in case of put option, it will be in the money. It's purely opposite. Then one second you wait. I will write it for you, which will more make you clear. Because this call put is really little bit confusing. Here we are talking about call, and we will talk about this put. Okay. So this is what subjected to buying the security, and this is what selling. Okay. Then the next point comes. Just a second. If price rises, the profits will also rise. Okay. But in case of put, if the price increases, the loss will increase. Okay. But in case of price, if price reduces, loss will be there. But in case of put, if price decreases, there will be profit. Okay. Then one more point, that is that in the money, out the money. Let's discuss this once again. Where it has gone. I am changing the color so you will be easily understand. This ST is the spot price, and SP is the strike price. Okay. I am writing in short, so I am giving the full form in advance. Okay. Here both will be equal. Then in the third case, Here purely opposite things will go. Oh, sorry. I have written opposite. Let me rub this complete. I hope now it is clear. Just make a chart in your notes to just add it to add this in your notes. It will be most beneficial because there is a lot of chance that question can be asked from this chart. So I have provided this summary to you. That is the, in case of forward, there is agreement to buy underlying asset at a specific rate and specific date in future. The forward contracts, the flexibility, more flexibility than the other derivative contracts. Contracts are customized forward contract. We have seen that these are customized. These are over the counter traded, and here high contemporary and credit risk is there. Okay, then in case of future, we seen similar to the forward contract, trade on the established exchange rate trade. Then the fixed format size of the expiration and follow daily settlement procedure. Okay, in case of option, we have discussed just two types of option, call and put. Then right, only right is available, not no obligation. No obligation is available for seller. Options are an obligation. Okay. And the first point is gives the holder right, not the obligation to buy or sell the underlying asset at a specific rate and date. Okay. Then last comes the swap. Swap is the most indicate the desirable tool. Swap are most indicate the desirable tools. उसके बाद most involves the exchange of fixed cash flow and floating cash flow. Then similar to other type of derivative, swap can be of to commodity, currency, interest rate swap or more. Okay, so this was all about today's topic, that is derivative, forward, future and options and swaps. I hope you might have understood this in clear. This is now crystal clear to you. We will meet in next video. Thank you. Bye. If you like the video, please hit the like button, because your one like gives us a lot of motivation.